Well, it is that time of year again. No, Faso, it is not time for you to dress up as Santa and invite little children to sit on your lap. It is the time that we review the dividends that are being declared by mutual insurance companies. So join us for this week's episode.
Enjoy the episode.
If you're an investor or want to be an investor and you're looking to create passive income that exceeds your monthly expenses, then this is the podcast for you. Here on the Infinite Wealth Podcast, we combine the philosophies of Robert Kiyosaki's Rich Dad, Poor Dad, along with Nelson Nash's infinite banking concept. Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso. And like we said in the hook, today we are going to be talking about mutual insurance companies' dividends and if they went up, if they went down, or if they stayed the same. Anthony, what's your projection? What do you think happened here?
Well, I will say that most companies raised them last year. Honestly, interest rates have risen, so I would expect them to raise them. And I know you got the answer.
I do.
But what was your expectation as you were doing research?
I was optimistic. I thought they were going to be raised. Markets improved. Everything's looking up. They also most insurance companies increased loan rates, right? Which also brings in additional revenue. And so that is something that adds to the dividends and total profitability. So
good point.
That was one thing that stood out to me over the last 12 months. And so I was optimistic that they were going to go up. But if you look at last year and look at the jump in which they did, everybody was declaring record-breaking dividends. Yeah. So I don't know. We'll have to see. What do you think?
Okay. Well, cannot wait to hear what your answer is. But before we dive into that, Cameron, can you tell our listeners, kind of give them an overview, like what the heck is a dividend? What is a dividend interest rate?
Yeah. So great point. Thanks for asking, Anthony. Guys, what we're going to be talking about today is I'm going to be sharing really two numbers with you that we believe is important when monitoring dividends. One is going to be a dividend interest rate, and the other one is going to be a dividend. The difference between the two is this. The dividend interest rate is actually made up of three components. One, it's going to be an expense component, right? So insurance companies need to pay money out of their pocket to keep the company going. Two is going to be a mortality expense. So unfortunately, people pass away. This is a life insurance company. So the individuals that pass, they do need to pay out death claims. But the third component of that is going to be investment return. And so insurance companies take money in, they invest money, that all goes back into the same pool. So at the end of the year, they net all those all those monies out. And then what they do is they're going to pay a dividend. And so that dividend interest rate is the rate that they use to communicate to policy owners what they're going to pay. I will say that the dividend interest rate is not uniformly calculated across the industry. And so we're going to open this podcast up again, letting our listeners know that the dividend interest rate is not a good measure for comparison amongst companies. And so we hope you guys understand that. The other number we're going to be sharing with you is going to be the dividend. That's the actual dollar amount. So the amount that these companies are going to be paying out to policy owners. And so we want to keep an eye on both of them.
Okay, perfect.
Yeah. Let's go, guys. What we did is we compiled the information of, probably very popular, some of the companies that we write with, certainly the top two companies that we write with, and then we threw in some other ones to give you guys an idea of what's happening overall. But Anthony, like I said, I'm going to share some information on these companies. We might talk about it and then move on. Sound fair?
Okay. Yeah.
Great. All right, guys. So Penn Mutual last year, 2024, the dividend interest rate that they declared was 5.7, and they paid out $200 million. This year, their dividend interest rate has actually gone up by 30 basis points. So their dividend interest rate is 6, and they're going to be paying out $265 million in dividends. So great year for Penn Mutual. The other stat that I'm going to be sharing with you guys, and I'm going to ask you, Anthony, this is kind of a quiz, is these mutual insurance companies have paid a dividend, right, for a number of years consecutively. And so, Anthony, I'm going to ask you to guess the number of years that Penn Mutual has paid a dividend in succession.
Next year's dividend will be 175.
You're right, man. Well done. Well done.
That's
Spot
probably the
on.
only one I know.
Spot on. You're right on the number. Well done, Anthony. So that means that every year they paid a dividend for the last 175 years. That's a metric that we monitor. And so that shows a great stewardship of funds.
Mhm.
So kudos to Penn Mutual. Moving on, Lafayette Life. In 2024, they paid a dividend interest rate of 5.3, and they paid out $103 million. In 2025, that dividend interest rate has actually gone up. It went to 5.57, increase of 45 basis points, and they're paying $123 million out.
Nice.
Yeah, absolutely. Anthony, any guesses on Lafayette? They're
I would say they paid dividends for 142 years.
Close, 120.
Okay.
So they're back. They're just behind Penn, but they're certainly up there. All right, moving on to Mass Mutual. Mass Mutual 2024, their dividend interest rate was 6.1. They paid out $2.2 billion with the B in dividends. 2025, they're increasing their dividend interest rate by 30 basis points. Their dividend interest rate is 6.4, and they are paying out $2.5 billion in dividends. That's a lot of money. Anthony, any guesses on the number of years consecutive they paid?
For Mass Mutual, I would say 187.
Ooh, close. 157.
Oh, really? Okay.
157 consecutive years. Northwestern Mutual, in 2024, their dividend interest rate was 5.15, and they paid out $7.3 billion with a B. Wow. 2025, their dividend interest rate also went up. They went up to 5.5%, and they're paying out $8.2 billion.
Wow.
Man, right? And yeah. Anthony, any guesses on the consecutive?
I'm going to say 162.
Closer, 153.
Okay.
All right, moving on to New York Life. New York Life in 2024, they paid out 5.8 dividend interest rate or $2.2 billion. And for 2025, as of today, November 14th, they have not declared. So we're a little bit early on what these guys, right, as far as them making a declaration. I looked at last year, and they declared on November 20th. And so we might be a little bit early, but I would expect these guys to also declare an increase. Anthony, guesses on number of consecutive years?
Consecutive years of paying a dividend. Mm-hmm. This is New York Life?
New York Life.
I'm going to say 182.
Ooh, you're close, man. 171.
Okay. 171. Somebody is more than Penn, and I don't know who it is. Penn is the second oldest mutual insurance company.
The last one that I kind of tracked on here was One America. Mm-hmm. The reason I wanted to include One America is, again, as of today, they have not declared a dividend for next year, but I do like to include these guys. In 2024, they declared a dividend of $32.4 million. But again, right, if you guys listened to our last year's podcast, One America does not declare a dividend interest rate.
How come?
Exactly. What I mentioned in the beginning is that, again, the way that insurance companies are declaring those dividend interest rates, it's not uniformly. So they can declare a gross dividend rate, a net dividend rate, right? Insurance companies can not include mortality expenses, not include management expenses. And so, again, you got to be really careful. And so One America several years ago said, hey, guys, we're not even going to play this game. And so now what they declare is they declare dividend payment. They do not declare a dividend interest rate. Anthony, consecutive years for One America. Any guesses?
I'm going to say 131.
Nope, 147. You are wrong again. So, Anthony, I think that's 5 or 6 in a row where you've been wrong. A typical week around here for us. So, Anthony, the other thing that is important, I'll go into it.
Go ahead.
Yeah. Guys, we're sharing this with you. One, again, is because you guys do want to track kind of the performance of these insurance companies. And maybe I'll ask you, your expectation was dividend interest rates to go up and dividends to go up. Was that kind of what you expected there, Anthony?
Yeah, it was. And I would tell you, to be honest, I expected some increases last year. Mm-hmm. And I noticed that Penn Mutual did not increase their dividends in 2024. But to me, I didn't have a problem with that because really we're just coming out of this low interest rate environment. I'd rather the insurance companies be a little bit more conservative, right? And we need to make sure we have money in the long run, not so much on the short run. So I would rather have them pay a little less dividend and have some more money in reserves for if something happens. But this year, I was expecting everybody to go up.
Yeah.
And even with Penn, which Penn is one of our main carriers, but one thing that's interesting with them is that when they adjust the dividend rate, they anticipate not doing that for 2 to 3 years. So they're a little more cautious of when they make a change, and when they do, we should expect that to similar to stay the same for 2 years.
Yeah. One of the best pieces of kind of material that I've seen from them is their consistency on the dividend. They're very slow to move it. A lot of companies will fluctuate rather quickly, but Penn is very consistent in that regard.
And, a lot of companies did raise their loan rates.
Mm-hmm.
So I was expecting the dividend rate to follow.
Mm-hmm.
And that has been the case. Now, Cameron, I want to ask you a question. You had said before that comparing these dividends to the other carriers it didn't seem like it was that important or urgent. So do you want to explain how important are dividends when we're evaluating the different companies?
Great question. My advice has always been for someone to look at an illustration. Don't compare companies based upon dividend rates or whatever else. Is you always run an illustration and make that as comparable as you can. The reason I say comparable is because some companies, the reason that we write with different companies is some of them have a better sweet spot for certain policy designs, as do others. And so, guys, if you're out there and you're comparing, you're trying to figure out which is a good one for you, look at the illustration, compare cash values. That's a great starting point. And then ask your coach, ask the guy that you're working with for some input. And so that's the best way to get started. The other thing I'll add is don't look out past 20 years. Yeah, right. We don't know what's going to happen in the next 2 or 3. So when you go out there and run a comparison out 30 years, I'm not a big fan of that.
And what I would add, dividends is a piece, and honestly, I would say it's a small piece to the overall performance of the policy, because there's a lot of other things that go into play on what is a good policy for you. For example, I know one of the companies that have a higher dividend rate, again, Penn's being one of our main ones, they have a higher dividend rate than Penn. So it may think that, well, maybe we should go with that company. But one of the things we rarely use that company is because their lack of flexibility with the PUAs. So maybe you get a higher dividend rate, but what happens when life happens and you can't pay? You need to lower your deposit. And some companies will only allow you to make that change on your anniversary. Mm-hmm. You know what I found out? Rarely does a life event happen in correspondence to the anniversary of your policy. So there's some games that need to be played to try to borrow from and to try to lower, to pay the premium. So that flexibility is important, but also there's, again, a lot more that impacts the growth of the policy than just the dividend rate. So really, we need to compare really the bottom line, the cash values. And I remember I got in a competitive situation. I won't name the company, but the guy was pounding how great their dividend was.
Mm-hmm. Mm-hmm.
Awesome. Okay. Do you want a higher dividend or do you want more cash value? Because the way that we designed it, because of this flexibility with some of the riders, we had more cash value. So if your goal is that make a lot of dividends, then that's what you should focus on, on companies. But if your goal is to create access to more cash value, that's what we need to focus on. So honestly, people will ask me what the dividend rate is. And to be honest, most of the time I tell them no clue.
Because you don't have a clue.
That's partly I don't have a clue because I don't want to have a clue.
Yeah.
Because to me, it is distracting. It's really, we want the flexibility and a high cash value policy and a good coach on your side to help you execute. You get those things, the dividends, again, play such a teeny piece. But in regards to dividends, Cameron, what are the options you have when they declare this dividend? You get a dividend applied to your policy. What can you do with it?
Yeah, not a lot of people are aware, but that dividend, you have a dividend election, which means that you can direct that dividend to certain places. The way that we design policies and the way that I recommend somebody have their policy set up initially, especially during the accumulation phase while we're building, is to have those dividends cycled back into the policy to purchase PUAs. So what's happening is that dividend is going to get declared by the company. It's going to roll right back into your policy, purchase PUAs, and create additional cash value for you. So buying PUAs is the first option. The second option is that you can actually use that dividend and you can apply it to premiums. So it's called a premium offset, right? So typically clients are going to look at this option maybe later on in life when they want to stop paying or lower the amount of premium that they pay out of pocket. We can redirect that dividend to pay that premium. And so that's one option that we could do as well. The third option that somebody would want to consider would be you can always take that dividend and apply it to pay down the loan, right? So we're actively banking. We've got loans on our policies. If at any point where we need or want to start paying down a loan, but we don't want to do it out of pocket, we can use that dividend to kind of lower that on an annual basis. And the last option that we rarely ever see is, but you can have that dividend paid to you in cash. And so what they'll do is you can ask whatever mutual company to send you a check, and they will. So those are four typical options that somebody can use to elect on their dividends.
Now, Cameron, when somebody gets a dividend, no matter how they choose to apply it, what's the tax rate on that?
0.
Okay, just wanted to hit that home.
Guys, again, today was our annual review of dividends, kind of seeing where they were. Man, what a great year for insurance companies, mutual insurance companies. Everybody's dividend went up. And again, that's a direct reflection of their stewardship of those funds. And guess what? All of us policyholders get to enjoy those benefits. So hope you guys enjoyed this episode.
Go make it a fantastic day.
Take care.
If you like this video, I know you're like this one. And if you want to learn how investors use infinite banking to increase their returns and lower their taxes, check this out. And if you have some questions and want to see if infinite banking is for you, hop on a discovery call with us. Link for that will be in the description.